and this is the third session on mutual funds. Today we are going to see the investment returns in mid-cap funds, how to select mid-cap funds, also as well as small-cap funds, because there is always a fear that mid-cap and small-cap are very risky. True, they are quite risky, but normally investments should be considered over a period of 3 years and 5 years, because within a year even large caps can sometimes fail, and even ETFs can fail sometimes. What we have seen in the last 25 years or so, there have been 6-7 instances of Nifty closing in a negative on a year-on-year basis. Of course, 18 to 20 times of the 25 years, Nifty has closed on a positive basis compared to the previous December. Suppose if this December it has closed at some say 17,200 or so, so next year we can generally expect a positive thing above 17,200. So any close below 17,200, let us say last year 17,200, that is December 2021. Any close below that, probably you can definitely go in for a buy. So generally on a year-on-year basis, Nifty closes on a positive note. And if you say over a period of 3 years and 5 years, in 5 years I think the negative return has been very, very rare. On a rolling basis, it's a very rare combination that you may have a negative return over a period of 5 years. Generally, the positive returns over a period of 5 years during a bull market or even over a period of time, generally we get something like 15%, approximately 15% for large caps. And multi-cap and flexi-cap can also return something like 17-18%. That is what we have seen. So, a period of 3 years and 5 years, they do well. Sometimes we have seen thematic funds also doing well. What we mean by thematic funds or sectoral funds, or the funds which invest only in a particular sector. Now we have seen this. We showed last time that the sectoral funds could be like it could be on the bank, then it could be on the infrastructure, it could be on IT, it could be consumption. So it can also be international funds. International funds are there. So these are all some of the sectoral funds. Generally, sectoral funds are a little risky because the investment is heavy in one particular sector. So if that sector doesn't return well in that particular year or during that particular 3 years, 5 years period, there is a chance that probably we could end up at a losing proposition. So it's a question of mixed bag. There is you try to spread out a risk to some extent, but if you try to diversify risk too much also, the return can be a little poor because one can drag down, another can go up, so it could become an average. So what is very important is that we should look at the past statistics, one, of which type of funds do well, whether it's large cap, multi-cap, consumption fund, or mid-cap or small cap, one. And second thing, which fund manager consistently does well. For example, it could be HDFC, it could be ICICI, it could be SBI, it could be Axis, it could be Tata. So you have to look at which fund house does well over a period of time, say 3 years and 5 years. So if you go to any of the important websites which we already last time gave you, like Association of Mutual Fund India, so AMFI you can go. Then there's another good site, Value Research Online. Then you have got Money Control. So you can look at some of these sites and get some information on the mutual fund, the performance, the ranks. So you can just pick it up. And also, in order to get yourself convinced, you can look at the holding pattern of such mutual funds, so that you will know that the stocks in which they are invested are some stocks which are known to you if you are already in the market. And if you're looking at the overall stock markets, some of the or most of the names be quite familiar to you, and that can give you the confidence. So it is very important to make those type of assessments. Then after that, you have to decide about whether you want to invest a lump sum or you want to go for the SIP. So there, very important thing that we last time said is that in the case of big caps, large cap, multi-cap and all, normally the fall or the fall in the equity market, generally the index itself, we said the amount of fall in index could be something like 5% in normal corrections, and in some abnormal correction in the last some deeper correction it comes closer to 9%, and exceeding 9%, something like 12% or so it comes sometimes. This in December, over a period of 2-3 months, there was a fall to the extent of around 12%. So normally, the corrections are LDR, and only very rarely you see corrections much beyond even 12%. So that could happen once in 5 years, once in 3 years, like that type. So generally in a period of 1 year, the corrections are generally halted 5 and 9. Sometimes it goes up to 12%. Now, during those times, the large caps also may go down only to this extent. It will not go down much deeply. But whereas in the case of mid cap and small cap, if equity indices go down by 12%, the chance that those things could go right down up to 25%, because normally the volatility in the small and mid caps is higher than large caps, right? So because of that, if the index falls by 5%, the chance it could fall by 10%. If this falls by 12%, that could fall by around 25%. So there is an inherently greater risk as far as the mid cap, small cap, and thematic or sectoral funds. So what you should do in that particular case, should decide whether it is better to go for lump sum investment or whether you should go for SIP type of scheme. So SIP stands for Systematic Investment Plan, where you invest a fixed amount, at periodic intervals. So here you can probably invest on a weekly basis, monthly basis, daily basis. So you can pick up your type of SIP that you want, and you can transfer that amount for a systematically investment, which probably at some times could prove to be very, very favorable in a falling market. Now, during the pandemic time, when equity indices fell steeply, instead of one lump sum payment at some place, SIP type would have probably helped you to weather that and get an average, and the return because of that SIP can be very high. Now, if you're looking at lump sum payment, you should be prepared for some shock at some stage. So the first thing is better wait for the index to fall at least by 5% from the top before you make one lump sum payment. Then wait for an 8-9% fall. Then you wait for 12%. So these are the things. Suppose if it goes even much deeper, then you should have some more amount of investment, so that on average you should be in a position, suppose if the market falls by 25%, because the more than 25% is an extraordinary event which comes once in a decade. So once in 5 years, 6 years, there is a chance that a 25% fall can come. So we will stop our discussion with 25%. 35% is extraordinary. So on an average, in the case of equity funds, ETFs or large cap funds, if there is a fall to the extent of 25%, your average should be at least 12 to 13% from the bottom or from the top, so that the return can be higher once the market starts picking up. So we should invest something closer to the 5%, 9%, 12%, like that. That is one. But sometimes even without a fall of 5%, there could be a fall of 5%, a little this one, but 9% fall and all probably could be may not be that easy. Okay, so in that particular case, what you do is that you go for probably investment which is around the daily basis or weekly basis or something like that. But there, in a climbing market, what happens in a climbing market, the return could be a little lower, because every day you will be averaging at higher level, right? You will be averaging at higher level. Now, if you see the present equity trend also, the last 1 year in the ETF, if you have invested on a daily basis, probably you would have averaged at something like an index equivalent of 16,000. That is, if you have invested over a period of last 200 days, that is last 200 working days from January to December 2020, your average thing would have been around 16,000, which means right now with the market at around 17.6, 17.7, 17.8, the return could have been 10%, 10%. But you should not look at 10%, you should look at it as 20%, because you have not invested that entire year right at the beginning, right? So it was over a period of 200 days, which means it is halfway in between. So this is a 6 months return. This is a return which is 6 months, which translates something closer to 20% per annum. This 20% per annum. Lump sum amount, even if you have invested 1 year back, if you have invested also, the return would have been 23% on a year-end basis, December to December. The return would have been on 23. Return could have been on 23%. So one way what you do is you try to compensate this slightly. Instead of going for one lump sum payment, you slightly increase the quantity and make it an SIP. That's all. It's by 1.5 times. Suppose if you are investing something like 1 lakh, 1 lakh. So over a period of 200 days, this could translate into what 500 rupees per day, 500 rupees per day. Okay, assuming that is what you are looking at investment in multiples, we have to see how much, what is the thousands, because some funds, rare funds, put in 500, some funds will put for 1000 rupees. So let us say multiples of 1000. So in that case, you would have invested something like a 2 lakhs, right? So at 1000 rupees per day. So a lump sum payment on December 2020, instead of, you would have done 2 lakhs, right? So instead of that, what you do is, you make, instead of 2 lakhs, you make it, this total SIP something like a 3 lakhs, which means 1500 rupees or 2000, in whatever multiples of 1000. You slightly increase the SIP so that you decrease your risk. You slightly decrease your risk of investment and look towards getting a return which is equivalent to something what you will get in a 2 lakh lump sum payment, because you don't need to worry about a fall of 5%, 10%, 15%, because if it happens, this SIP scheme will average it out, at various levels. So SIP scheme to that extent will be very useful for you doing this particular type of averaging process that takes place. So instead of trying to look at one particular investment at one particular level, look at an investment which is over a period of time, and the SIP to a very large extent solves this problem, right? So we will look at such type of funds which are given a return. So we will look at what happened as far as the mid cap funds is concerned, small cap fund is concerned, which fund is good, and how an SIP return has been beneficial in those type of schemes. So we will look at some of the sites which you have already mentioned. Okay, that is the value research online. We can look at moneycontrol.com. We will come to some decision. So whatever I told you is applicable not only this type of investment, it's applicable not only in terms of the multi-cap or large cap which we have seen. It is much more useful as far as mid cap and small cap, because mid cap and small cap carry a greater risk than the large cap, and because of that the SIP scheme there is much better. It's much better as far as the mid cap and small cap funds is concerned. So now let us look at how we do this. Okay, so there are, of course, as I told you earlier, that the first stage of looking at is ETF. And ETF, it doesn't mean that it is only Nifty. There are Nifty. Then you got the gold Bs. So these are indices based, and this is generally on the gold. Okay. Now you got other Nifty ETFs also. One is the ICICI Pro, which is basically the IT thing. Then you got Motilal Oswal 100, MON 100, which is invest in Nasdaq 100, which is the international thing that you get. Then you got some schemes driven by Edelweiss. Okay. Then ICICI itself, ICICI value 30 or something, is the NV 30 or so. So there are funds, ICICI NV 30. Then you got Edelweiss. So there are a lot of ETFs like that. Okay. And you can look at some of this. Now instead of looking at the IT digital funds, which is also the same return it will give, you can put an ICICI Pro in the IT fund. So what you can do is, you can open your terminal. Okay. So let us say you're a client of Goodwill, and now you go there and then look at the screen and add this ICICI Pro in that, okay, in your screen watch list. Then every day you buy 1000 rupees. Okay, so every day you blindly buy 1000 rupees. Okay, so just wait, because investment is a long-term game. Trading is a short-term game. So in order to ensure that you have a good return, okay, over a period of time, investment is one investment in equity markets, and investment in one of these type of schemes will help you definitely stand in good stead, no doubt about it. trading is something where you should have the skill, where you should have the emotion, where you should have the what I would say is that a very pakka system, okay, and the system implements it. So now we got a lot of algo based softwares probably that can help you. But now looking at the investment angle, so you can pick up one of these ETFs also, because how to implement it. Now the question is first to choose what type of funds and how to implement it. Now implementation of the ETFs, you can pick up some of these known ETFs, put it in your watch list, and if you want to do a lump sum payment in case if the market comes down and you feel it has come down to reasonably low level, maybe a 5% fall or a 10% fall, then in that case you can look at some of these type of ETFs which are there and straight away invest whatever lump sum thing that you want. But suppose if you are not, you do not know, you are not following the market and you do not know what correction is, all those, so leave that headache alone. So what you do is that you just put some daily, do 1,000 rupees. I think there are facilities also available for a very systematic transfer to some of these schemes. So you can do 1,000 rupees. Either you yourself can go and type and purchase those things. And normally the amount of commission and brokerages is far less than probably what you may have in the case of a mutual fund. Another advantage for us is that since this is these schemes are available to us, it can be done in a very transparent manner at a low cost. It can be done with it in a much more transparent manner than other mutual funds, than other than ETF schemes. This is much more transparent because you see the NAVs in the screen. Immediately exit is there, instead of you trying to go and ask for an exit through going to the mutual fund website and then asking for a redemption. Instead of doing all those things, you can as well do this. Okay, you can as well do this. So you have this facility available for you, and if you want at any point of time you want to sell, you sell and then shift to some other type of schemes in the ETFs or something like that. So you don't need to worry about any exit load or entry load, whatever probably other mutual fund schemes have. So the ETFs has its own advantages in terms of the transparency, ability to execute in a very rapid manner, like the way you buy or sell your stock. Then you can keep a track of it. Look at also all facilities are much better as far as ETF is concerned. So there you can do a very systematic investment plan, like every day or every week or whatever time frame that you want, or whatever correction that happens, you can go and do that. So the mutual fund, as far as the mutual fund is concerned, you have to identify which asset class you want first. So that is equity. Okay, now we are talking about equity. Now in equity, whether you are an aggressive investor or what type of return and objective that you are looking for. So you are either a conservative within the equity class, or whether you are aggressive within that. So this will define whether you want to go for normal index based ETF or large cap. Okay, this is index ETF. Okay, large cap. Then after large cap you have the multi cap or flexi cap. All those things come. Now aggressive, you will go for mid cap, small cap, then you will go for sectoral. So these things will define where you want to be, because some of the aggressive funds have returned very high returns, which we will see. Particularly the IT sector has done extremely well over a period of time. So that is one thing which can be looked at. And also some of the international funds have done extremely well. Then you can look at the mid cap and small cap. So now we will look at mid cap. So we now identified, let's say how the mid cap has performed compared to large cap and multi cap. One. Second thing, which fund house has done consistently well in that particular segment. From there, then we will look at what type of portfolio holdings they have got. Then also we will look at whether a lump sum payment over 1 year back or a SIP has worked better. So this is how these are the different stages. Okay. Now we will look at, let us say we go to see, this is the in the moneycontrol.com we have chosen the mid cap funds. So we have also looked at the return. So this is in white background, so maybe you have difficulty in reading it, but this is in terms of rank, so I will read it out for you. So 1 year, 2 year, 3 year, 5 year period. So in that, let us look at one of them who have done well. Axis Midcap Fund. Axis Midcap Fund is ranked 2 amongst 21 in a 5-year period. In a 5-year period, and the 6th among 23 in a 3 years. So generally over a period of 5 years, that means probably their outlook is much better as far as the longer term is concerned, and that is why they have done well. Now, when we look at the whether we'll scroll down and see who has done much better in the 3-year period, I think we have got Baroda Midcap Fund, which has done well. They have also done in the 3-year period, and in 5-year period they are not that worse. So the Baroda Midcap Small Cap has done well. Then this one, which is the Edelweiss Midcap Fund. So Edelweiss Midcap also has been generally done either as the 4th rank or 5th rank. So we will confine ourselves to this. So let's go back and look at the Axis Midcap Fund. So we will click this and look at what has happened at Axis Midcap and what has been the return. And over a period of 1 year, this scheme has returned something like a 40%. Okay, this scheme has returned 40%. Over a period of 2 years, it has returned 36.6%. And over a period of 5 years, this has done 25.05%. So generally, it has been the category average. So if you look at this, the average of this particular category, most of them has done on an average is 19.5%. So Axis has bet that. So that means they are 6% more than the average. And also in the 5-year period, we have seen them as number 2. And in the 3-year period, we have seen them as 5th or 6th among 21. So it makes sense to look at Axis Midcap. Okay, this is one example I'm giving you. I'm not trying to promote anything. So let's look at the over a period of 1 year, 2 years and 3 years, what has been the return. 1 year annualized return is 40%. Okay. 1 year, if you look at it, probably the category average is 43.41%. So we can say that probably they are slightly worse in a 1 year period. On a 2 year period, they are with the category average. But if you look at 3 years, they are now beating the category average by 3%. And over a period of 5 years, they are definitely beating the category average significantly. Whatever said and done, now we are getting what returns that we are getting in any of this thing. We are getting something like 25%, and even in a longer term, it's more than 21%, which means it is a very, very good thing. And over a period of 5 years, they've done 2 out of 21. So this is one sector which you can look at. Now, having looked at it, what is the SIP returns that we are getting? Okay, the same period, we will look at the 1 year, 2 year and 3 year. Now, 1 year period, say 1 year period, they have return of 35.58%, which on a lump sum payment may be a little lower, 40.11, but here is 35.58. But look at 2 year, the return is 36.6, and this is 44.6% over a period of 2 years. Okay, over a period of 3 years, you look at this 27.72, and there is 36.52. So in a 5-year period, also it is 25.05, and there is 27.18. So very clearly that in case of midcap, now generally speaking, it is better to be in the SIP mode in order to get a return which is quite fantastic over a period of 1 year, 2 years, 3 years and 5 years. Okay, so a consistent type of investment, okay, over a period of 3 years and 5 years in SIP scheme, no, generally has been an extremely rewarding scheme as far as the midcap is concerned, as far as Axis is concerned. So this is one example, and let us look at the probably the holdings which they have. So when we say the mid cap, I think the holdings are generally known. I don't know how the ICICI Bank came here, but Cholamandalam Investment, Coforge, Astral, Avenue Supermarts, Mindtree, Bajaj Finance, Apollo Hospitals, Crompton Greaves, HDFC Bank. I don't know how it came here, but in the mid cap. But probably they can invest, if they are in mid cap, they can also invest a little bit in large cap, and that is the reason why it has come. So you can see large cap investments is 11.68%, mid cap investments is 53.5%, and small cap is 12.8%. So that means the mid cap has to be more than 50%, and they have done that with 53.5%. So and if FN holdings is only 1.24%, equity holding is 91. and total 92, so remaining maybe in cash. So this is how no the so these are some of the stocks which on our own basis we'll find it very difficult to hold, because for a small amount we can't keep on doing an SIP in all these type of stocks. So that is where the funds play important role for us to. So what we can do is that investment we should put it a little bit in mutual funds, and investment we should put in some stocks which are known and looking quite bright. I mean, like, some names will which will come which have done extremely well over a period of time. You will come to know about it. Maybe some stocks which you can hold, like TCS, Titan, Asian Paints. So some of these stocks are also held by these mutual fund. Most of the stocks of what we are mentioning will be held by these mutual funds also. So that will give you a growth. But because if we do a very concentrated portfolio in stocks on our own, there is a chance of an absolute rout, because some stocks like S Bank, you know what happened to that. So when such things happen, then we will be left very clueless also how to get out of such a stock if the portfolio is concentrated. But funds normally, they are not concentrated in one stock heavily, and they know how to get in and get out, and also better resources, more knowledgeable, and also more information, more analysis. All these things will definitely help them to beat what we can do, and since they also do it very consistently. And also we look at the volatility. That's also very important. So we should not go for too much of volatility. And if you look at the risk-adjusted returns, it is 1.21 against a category of 0.85. That means they are definitely better rewarding for the risk that the funds is taking. So that is one thing which we and there you can look at the alternative funds which are there, which are category peers which have done well. And though some of those funds which have done over a period of time, 1 year and 2 years, some of the other funds might have done very well compared to even Axis, this one, and some of them are already in there, this one. So you can look at their SIPs also and look at whether some other funds will suit you compared to Axis. So over a period of about 3 years, if you see, most of them have returned something like 27, 28, something like that. And over a period of 5 years, you have to see what return they have gotten. So in the longer term, Axis has done much better, and the risk-adjusted returns is better. So this is analysis. We are not trying to promote anything. If something else has a better risk-adjusted returns, or in the SIP they are given better, you can look at it. For example, let's look at Motilal Oswal Mid Cap 30 Fund. Okay, so let's say what is the return they have given. Category average is 43.4, but this scheme has given 56%. So that means on a 1 year basis, they have done extremely well. And if you look at the 5 years basis, category average is 19.44, but the scheme has done only 17.6. So longer term, they have not done that well. Okay, so this is how the comparison is. And no, you have to look at which one will suit you, because then you can look at the SIP returns also in this. So SIP returns over a period of say over a period of 3 years, it has done 40%, and over a period of 5 years, it has done 25%. So more or less, if you do an SIP return, you are assured of a return which is more than 25% over a longer term, even in a mid cap, and in a shorter term, probably it could be even higher, depending on the fall that takes place, because all these things, 1 year, 2 year, 3 years, are showing higher return because of the fall that had taken place during the pandemic time, and because of those returns are looking very good. So we should look at a 5 year where probably there was a fall also and there was a rise also. So we need to look at because in a period of 5 years or so, normally there can be some big fall, which is approximately 20-25%. So that time this will help to smooth. Now what you should do is you should do the SIP consistently, and during a bigger fall you should do some lump sum amount. So let us say the fall takes place 25% or 20%. Having invested through SIP, you just do one more lump sum payment, which will give you much higher return. So that is how you normally do your planning. So this is as far as the mid cap is concerned. Now we can look at the small cap funds also. Now so let's look at the small cap fund. So the small cap funds, let's look at the 3-year and 5-year who has done well. Let us look at the 3-year. I think BOI AXA Small Cap Fund Direct, that has done extremely well over a period of 3 years. 5 years there is no history, but they have done well over a period of 2 years also. 1 year they have not done great, but anyway that's also good. Let's look at somebody who has done over a period of 5 years. I don't think we have much of 5 years history, so not many are 5 years history, except for L&T Emerging Fund. So most of them in small caps, we don't have much of a knowledge about that. HDFC Small Cap Fund Direct Plan Growth, they have been 6 out of 13, so that means on an average. So let's look at somebody who has done 2 out of 13. So I think Axis Small Cap Fund again, no, it's a little bit more consistent, Axis and Nippon. So let's look at Axis Small Cap Fund, who have done decently over a period of 3 years and 5 years, but over a period of 2 years and 1 year, they have not done well. So that means they are looking to be a slightly longer term fund. So I think over a period of longer term, they seem to be doing well. So let's look at what's happened as far as the Axis Small Cap Fund is concerned. And since what has happened is now a period of 1 year and 2 years they have not done well, that means next year they will continue, probably their performance, if it is going to be 3 years, it's going to be improved. Then in that case, this performance has to jump in the 1 year period itself, right? That is how we could make some conclusion. Or over a period of next 2-3 years, this has to jump considerably. So let's look at the return that even that performance in 1-2 years when they have not done well, and let's look at the SIP also. So over a period of 1 year, I think the category average is 64% and they have come 57%. So even though we may say it is not done that well, it is still a very high return, okay, over a period of 1 year. Now 2 years, it has done 42% as against the category of 47. So that means though it has underperformed, it has done still very well. Now over a period of 5 years, this has done 25.33 compared to 20.83. So let's look at the SIP in this case. So SIP, over a period of for small cap, 1 year 51%, 2 years 58%, 3 years is 45%, and 5 years is 31%. So that means an SIP in small cap is definitely a very, very rewarding one, even when compared to mid cap. So as you take the risk, and if you are looking at 5-year basis, assuming that this type of returns is even slightly lower, then even then in that case, probably the return over a period of time, probably for a smaller this one. So let's imagine that somebody started investing sometime back, 5 years back or so, or even 3 years back. Well, let us say 3 years back. 3 years back, the absolute return that's coming is around 90%. So that means, if you have invested something like say 25 lakhs, okay, so it's almost like 50 lakhs. Okay, within 3 years, it has almost doubled, almost. Okay, so 88.05%, and over a period of 5 years, it has given an absolute return of 115%. So that means, absolute returns is investment. If you look at it, that's what I'm saying. 36,000 rupees has become 68,000, almost at double the figure. So if you have invested something like 10 lakhs, probably this would have become another 10 lakhs. So the 3 years period, you got 10 lakhs. Which itself, probably for investment of 10, you got 10. So that means that 10 lakhs you can take, which could be around like 3 lakhs or so per year, 3.5 lakhs per year, which is 30,000 rupees per month or so. So you invest even 15 to 20 lakhs in order to make 15 to 50,000 rupees per month. So you don't need to have big money for you to sustain yourself. So think about your retirement also. If you are a investor who is maturing into retirement, so if you are already 55 or 58, so maybe another 3 to 5 years you are looking at some, then probably please plan like this. So that a small corpus of funds can still enable you to sustain your lifestyle, okay, or maintain yourself. So here you look at the returns also that you are getting. Now, the holdings that's there. Large cap investment is quite low. Mid cap investment is also only 5.58%. Small cap investment is 70%. So what are the small caps? Birla Soft, Narayana Hridayalaya Limited, Tata Elxsi, JK Lakshmi Cement, CCL Products, Coforge. So these are computer software companies. So these are small mid caps companies which can grow to be a big large cap also at some stage. So these have done extremely well. So you can have a mix of these particular things. So let's look at the IT stock. Whether we'll go back and look at whether IT stocks. Multi-cap dividend. Look at sectoral funds. So here, okay. Now I see Tata Digital India Fund Plan. Okay, and over a period of 5 years, Tata Digital is 1 out of 74, and over a period of 3 years, is 3 out of 85. And even over 1 and 2 years, it's 2 out of 306 or 3 out of so very consistently good performing along with ICICI Prudential. So let's look at what has happened with Tata Digital Direct Plan. What is the return they have given? Okay, so 1 year compared to whatever that we have seen in small cap and mid cap, it has done 69% against a category average of 34%. And against a Nifty IT index of 52-53%. So which means Tata Digital Fund has outsmarted anything else. Okay. Now the same thing. Let us look at the 3 years, 2 years, and 3 years. So 2 years it has returned 65%. 2 years it has returned 65%. 3 years it has returned 45%. And 5 years it has returned 37%. So compared to even the small and mid cap, the digital fund has done extremely well, and since inception has done 29%. So compared to any of the category average, this has been an outsmarted index that has done very well. And SIP return, if you look at it, fabulous. Now 1 year is 72%, 2 years is 81%, 3 years is 60%. Okay. And 5 years is 44%. So what more you want? See, that is what I'm saying, that over a period of 5 years, if you have invested, and now also you please think about if you are at age of 55 or 58 or 57, 58, next 3 to 5 years retiring, 60,000 has become 1,73,000, almost 3 times. So if you're investing 10 lakhs, it's going to become 30 lakhs. Okay, so 20 lakhs is going to be over a period of you can use it. And if you divide it at a range of say 50,000 rupees per month that you want, then in that case it becomes 6 lakhs, and then you can have your sustaining clearly for 3 years. It will pay off. Then again, the original amount of funds, it is better that you invest that same 10 lakhs. That can also probably grow. So every 3 years you have the profit that is taken to fund your sustaining lifestyle for some time for 50,000 rupees also. So very easily, a very smart way of planning is to look at some of these type of funds. So we have given an overview of what are the funds that are doing well, from large cap to very high return of IT fund, which have bet everything. So you also looked at the SIP type of plan. And the SIP type of plan, how it has even bet the see 1 year is 69%, 71%, 2 years 65%, 81%, 3 years 45%, 60%. So clearly, I think the SIP works here, because any big fall, this is able to average it out. So look at some SIP plan, okay, and let us say you have invested, it says 60,000 rupees over a period of 60. That means 1,000 rupees per month. 1,000 rupees per month itself has given you this much. Okay, so you just look at it that probably instead of 1,000 rupees is 60,000 rupees. So you want to make it as 10 lakhs, so 15 times. So maybe you invest 15,000 rupees per month, 10 to 15,000 rupees per month, and see the return that you're getting here. So it's a fantastic return. So kindly look at this type of schemes over a period of time. It will definitely allow your money to multiply, and less resources still could mean you can have a good, very peaceful retirement with a small corpus of funds. Okay. Now, so this time is 7:40. Before we conclude, let's look at the Nifty and Bank Nifty chart and see where they hold right now. Now, Nifty 17,812, and it has smartly rallied in since December end, and looks to be on up move right now, and probably this trend line has to hold for it to move up. So probably I think any fall could still be a correction. So we should see correction holding above the 17,200 levels, and then probably climbing back to its previous peaks at some stage there. So Nifty looks on a longer term, it's good, because if you look at the monthly chart, it has broken the previous month high, which means this is going to be a very important low. Then we have got the daily chart, which means higher low, higher this one. So for a time being, you can keep this low as a stop loss of 17,655. You can keep as a stop loss for the time being. Or probably if it starts falling below this low, you will have some support coming here. 17,640.50 will be a support on Monday in case if there is fall. And only a sustained break below that probably can take it a little lower. So any investment, please look at it for a short term of 17,640. But we will have to look at the trading in a very different manner, because we have to ensure that while do the trading, your trading profit has to be more than the investment profit. Otherwise, there's no point in trading, right? So how do you do the trading? Do you do a trading using a daily chart, or you're going to use a smaller time frame chart? Which chart will probably help you to beat the investment? So that is very important for you to understand before you indulge yourself in trading versus investment. Because if you cannot know, the Nifty has grown from say 16,400, you leave it. That day the close was 16,000, probably 16,614, and that was on 20th December. Yeah, that was on 20th December. So assuming you started trading somewhere around this 16,614, no, probably you invested here. That's a very difficult call, because that will be at the lowest level. So still you should be something like a 1,000 rupees profit, which should be around 50,000 rupees. So your trading should be in a position to ensure that whatever maximum high that comes here, you are in a position to take it, from the bottom to the top. If that is possible, there's nothing like that, because from the bottom to top, if you can catch it, there's nothing like that. So we have to see whether you can do that, or probably you do both the sell side and buy side in order to make good of that. So that is going to be the most important portion that we are going to look at it. So kindly stay tuned to our webinars in coming thing to explain the intricacies of trading, also using a smaller time frame chart. So now we'll look at the Bank Nifty also. So Bank Nifty, okay. This is also looks to be on the upside, and monthly chart, let's see. So monthly, this has broken this particular high. So that means this is going to be a very important low. So keeping this low as a important place where probably it can bounce, it may not go down much below this. We can keep that as a very, very important place where the market probably can tip it off to a much bearish side if it falls below that. Keeping that, so any fall should hold about this particular high, which is 35,965. So I think probably any correction should be around the 36,000 for it to go up. So that's in a bigger time frame. In a smaller time frame, I think it's still on a clear up move, and probably at least it has to break this particular trend line. Right, so that's coming a little far off. So at least it has to break this particular 36,000 or not. So it looks to be a good this one. So there could be some sort of a fall, but I think it will still hold and then start to rally. So that's how we see this market right now heading towards. So let's hope that things turn out to be for the better. So stay safe. Happy weekend. Any questions, please ask now. Thank you. Thanks for your participation. See you next week again with a new topic. Thank you. Bye.